My favorite trade to do when the stock market is down. Hey everyone, welcome back to the Flex Free Game channel. Really excited to have you back. If you are passionate about the stock market like I am, like Courtney is, and you are looking for someone to help you through this, check out the link below after you watch the video. We'll set up a call with you. We'll go over what we do in our program, so check that out. And today, really what I want to do is I want to talk to you about my favorite trade to do when the stock market is down, right? So if you watched my last video, you saw that, I was talking about the market kind of trending downwards. There's a few things that I think are playing into that. One, the market was on a nice run, right? We're going into the end of 2024. The market had been on a nice run. We had some things going to all-time highs, and really the market looked really good. And just the way the market is, after the market runs, the big institutions are going to want to take profits. That's one thing. They're going to go ahead and take some off the top, go ahead and take some of those profits. But the other thing is they want to drive prices back down to places where they want to buy, right? So even if the stock market necessarily isn't in a bad situation, after a long run, they're going to knock stuff down, kind of get it down to where they want to buy, scoop up some more shares and kind of drive it forward. So we're seeing some of that. Also, you're seeing some uncertainty, right? We're seeing some uncertainty in the market around these interest rates, around inflation. Also, when it comes to the fourth quarter, especially Christmas time, in America, we spend a lot of money. That's probably the most money that gets spent every year is around Christmas time. So we are going to see some of those inflation numbers go up just because people are all spending money, and the Fed is going to have to make some decisions on what they want to do with these interest rates, whether they want to pause the cuts, whether they want to actually reverse it and start, increasing interest rates. So those things are playing on the market as well. We know from experience that any uncertainty in the market is going to drive the prices down, kind of make the market, behave how it has been the last few weeks. And so, how can we take advantage of this, right? How can we take advantage of a market that's on a downward turn, kind of having that uncertainty, like I said, and be able to still, stay profitable during these times? So today we're going to talk about one of my favorite trades, or my favorite trade in a down market, and it's called bear call spreads, right? So if you know us, we love cover calls. That's something that's a staple of our program. But something that's kind of similar to a cover call, it is a bear call spread. So we use these in a downward market because it actually allows us to bring in some profits without taking a lot of risk, right? And very similar to a cover call where you have to own 100 shares and then you can sell a contract off of those 100 shares and taking a premium. In a bear call spread, instead of buying shares, right? Because I don't want to buy shares because the market is going down. I don't want to be holding those shares as they're decreasing in value. What I can do is I can actually buy an options contract, right? I can go out and buy an options contract pretty far out of the money, right? And then so I can buy it for pretty cheap. And then I can sell a call against that. So instead of selling the call against 100 shares, now I'm selling the call against a contract that I own, and I'm still able to go ahead and take in a premium. And in a bear call spread, you're just taking in a difference. So whatever you buy that first contract for, when you sell the second contract, you get to keep the difference between those premiums. So that's a great way to bring in profits while the market is going down. A couple of things you want to kind of be aware of when you're doing this is, one, you do have to have the funds to be able to buy 100 shares of this, whatever stock that you're trading, because if, say, the stock price goes up and hits that second strike price, you are going to have to go ahead and buy those shares so that you can deliver them. So one, you do want to have that cash on hand. Two, you want to be able to generate at least 300% on this trade. So when I mean 300%, I want the difference from that first leg that I'm buying and the second leg that I'm actually selling to be a 300% profit. So we want to be generating at least 300% on that every time we do these trades. And the last thing is, I like to do these trades on stocks that I'm actually bullish on in the long term, right? The stock that I think could turn around and, actually turn around and be profitable, because there is a way that I can kind of turn this trade around and actually buy the shares, and start to generate some profits that way as well. So these are a few things that you want to think about. Now, why are bear call spreads better in a downward market than any other trade, or buying puts or something like that? So I like these better because in this situation where I'm doing bear call spreads, if the stock does turn around, there is a possibility for me to go ahead and continue to make money. If I buy a put and it turns around and goes the wrong way, I'm in a bad situation. I'm probably gonna have to go ahead and sell that at a loss, or hopefully I bought one out further dated enough that I have time for it to kind of turn around and for me to be right. But in a bear call spread, even if the stock turns around, I can still generate profits off of it. So let's say in the first scenario, the stock doesn't turn around. It just goes ahead and it keeps on dropping. That's great. I bought the first strike or the first contract, and I bought sold the second one. I brought in a 300% return, and now that stock continues to drop. At the expiration date, both of those contracts expire worthless. I don't have to worry about anything. I don't have to deliver any shares. Perfect. I continue, with the same process. Once it expires, I'll buy another contract, sell another contract closer to the money, taking my 300% and keep moving. Now, on a put, that's great as well, right? Stock keeps dropping, you pick the right direction, great. Now, in the other scenario, let's say you go ahead and set up your bear call spread, you buy the first leg for all the money, you sell the second one closer to the money, you take in your 300% profit and the difference of those strike prices and those contracts, and the stock turns around, right? So now the stock is going up, it's actually going to reach my second leg that I sold at, right? So now I have to go ahead and buy the shares and deliver them. What I'm going to do in this scenario is I'm going to actually buy the shares at $1 below the second strike price. So, right, I buy the shares, the stock continues to rise up, it hits my strike price. Now I have bought the shares at a dollar below, it hits that strike, I deliver them. So not only did I get that 300% when I bought and sold the contracts initially, but now I bought and sold the shares and got $1 on each share. So it's another $100 profit in that scenario. So I really like bear call spreads because if it does turn around, you can go ahead and still generate profits off of this trade and increase your profits instead of just taking in that initial 300%. Now I can actually buy the shares, sell the shares, deliver them, take in some additional profits. And let's say in this third scenario, the stock starts rising. It gets to about $1 before that second strike. You buy the shares, but then it stalls out and it turns around, right? So now I own the 100 shares at that price that was $1 below my strike. Never hits that second strike, so I own the shares. The contract's expired, and now I'm sitting on 100 shares. Now, if you know us, you know what I can do from now. Now I got the 100 shares. I can go ahead and start doing cover calls with those 100 shares. So any way this trade goes, I'm actually in a good scenario where I feel like I'm going to be in a good spot where I can continue to generate profits. And that's why I really love bear call spreads, because what I like to think of about it is it's just a way for me to enter the market, right? So we have different ways to enter the market based on what the market is doing. If the market is in a strong upward turn, I'm not doing bear call spreads because I want to take advantage of the volatility. I'm either going to be doing cover calls or volatility trades. If you've seen our channel, we go over volatility trades. We have a great tracker, like a volatility spreadsheet where it goes through everything you need to identify and follow through with to be successful in volatility trades. So that's what I'm going to do when the market is in a strong upward momentum. I'm going to use volatility trades, enter in that way. So I'm entering the market with a volatility trade and upward movement. Now, if the market gets stagnant, right, it starts going sideways. It's just, it's not really going up or down. It's just kind of a stagnant market. Really, we love cover calls in that scenario. Even in an upward market, I really like cover calls. There's some things we can do with the strike prices and expiration dates where, volatility trading, cover calls are going to be great. But when the market starts to turn around, that's when we like to use bear call spreads, right? So we're entering the market with a bear call spread because we have the highest probability of being successful with that in a downward market. And then after going over those three scenarios, right? The stock continues to go down. Cool. I'm still generating profits. The stock turns around and goes up. Great. Now I own the shares, sell the shares, make some more profits. Now the stock goes up. It hits my second strike, or hits my $1 below my second strike, but it doesn't actually hit that second strike. Okay, cool. Now I own 100 shares. The stock has turned around. It's moving in a positive direction. And now I can start selling cover calls. So that is a great thing no matter what's going on. And you just got to understand how you want to enter the market. And these three different trades are going to give you some great ways to do that. So that's going to close it up for today. Again, if this market continues to be in a downward trend, we continue to see some uncertainty. think of bear call spreads as a way to enter the market and continue to generate profits and be successful. Again, if you do have questions or want some coaching on this, again, check that link out below. Go ahead and sign up for one of our calls. Also, if you felt like this information was helpful, kind of help you with the market, help you with some different trading ideas as the market continues to turn around, hit that like and subscribe button. Also, leave a comment. What is your favorite trade to do when the market's in a downward trend? What are some things that you like to take advantage of? Let us know. We'd like to hear from you and kind of comment on that. And we'll see you on the next one. Have a good one.